simply, quickly, and interactively. Remember that you're free to watch each individual lesson as often as you'd like. So now, if you're ready, let's get started. Online trading cuts out the need for intermediaries, such as banks. There are many trading arenas a person can choose from to start to trade in. Yes, online trading can be a very rewarding experience, but like any other business, you must be properly prepared. The most important preparation you must do for your trading business is to get the proper training. Simplicity. Online trading is as simple as you can get. If you choose the right direction, you can make your profit. And the best thing is that you can trade from anywhere, anytime. Flexibility. With online trading, you are not limited to one market. You can trade Forex, indices, commodities. It is all available to you within the style of trading you choose. Transparency. With online trading, there are no surprises. You know how much you can lose and how much you can make. This lets you trade with ease and in a relaxed mode, which is the way you should always be when trading money. All Forex trading is based around a pair of currencies. As you can see, there are two currencies listed in this quote. The first symbol, EUR, represents the euro, so the euro is the base currency. The second symbol, USD, represents the dollar, so the dollar is the quote currency. The example shows that you'll need $1.3900 to buy 1 euro. Pips are the units of calculation used by Forex traders to calculate the profit and loss from the trades they make. Look at any currency quote, starting from the left, and count 4 places. The 4th place is the pips value in a quote. To calculate the value of pips, traders use a pips formula. 1. The asking price for the currency trade. 2. Divided by 1 pip. 3. Multiplied by the value of the trade. This will tell you the value of each pips gained or lost in the trade. In Forex trading, there are always 2 currencies being traded. One currency is bought and the other is sold. For one currency to rise in value, the other currency must fall in value. As a result, either the base currency or the quote currency will always be rising in value in the Forex market, which means there is always the possibility to profit. If a currency pair is rising in value, then the base currency is strengthening. By buying the pair, you can take advantage of this trend. If a currency pair is falling in value, then the quote currency is strengthening. Leverage is what transforms Forex from just another form of trading to a highly exciting but also highly volatile activity. With leverage, it is possible to greatly magnify the speed and impact of the trades you place. That means you magnify both the profit potential and loss potential of your trades. A trader opens a trade with a margin of $50 and a leverage of 200 times. The actual trade value will be 50 times 200 or $10,000. If the trade loses value, the loss will come immediately from the $50. However, if the trade records a gain, then the gain on the $50 will also be 200 times greater than it would otherwise have been. Because leverage can have such a dramatic impact on your trading, it is very important to set clear limits and targets for your trades in order to reduce the risk of a meltdown in your account. Let's look at a trade model. Say you want to open a trade on the euro-US dollar. You think the market will rise and the euro will strengthen, so you decide to buy the euro-US dollar. The rate is 1.4000 and you're willing to invest $100 from your account. You decide on a leverage of 100 times. The amount of the trade will be $10,000. Your margin is 1%. That means that if the value of the pair drops by 1%, then you will lose your trade margin and your trade will be closed. However, if the markets go in the direction you expected, then on a gain of 1%, you will profit by $100. You can then close the deal and bank the $100 you earned and the $100 you invested. Let's get to know the platform. The MT4 platform offers professional and fast financial market trading. Let's take a closer look at it. The platform consists of 4 distinct regions: Market Watch, Navigation, Charts, Terminal. At the top of the screen you'll find the main menu offering you access to most of the wide range of features which the platform offers. You can log into your account, open trades, and access charts and indicators all from the navigation menu. To the left of the screen, the Market Watch sidebar provides the latest price information on the dozens of tradable currency pairs, showing the symbol, latest bid, and ask price for each pair. At the bottom of the platform screen are a series of tabs you can use to keep track on all the latest activity. That includes trades, account history, alerts, messages, and a live journal of activity. You'll find the chart area in the center of the screen. The chart area offers a number of ways for you to quickly get at information. To see a new chart of any pair, right-click on the pair from the Market Watch sidebar and select Chart Window. This will bring up a new chart. To maximize the chart, click on the Maximize icon at the top right of the chart window. To switch between charts, use the tabs at the bottom of the chart area. Click on a currency pair to open it in a chart window. To open a new trade, click directly on the pair which you'd like to trade, either from the Market Watch sidebar or from an open trade chart. Next, choose the volume which you want to trade. This is recorded in lots of 100,000 units of the base currency. Next, choose to either buy or sell the currency pair you have displayed. When you've selected the choice you want, you'll receive a confirmation message and your position will be opened. To find and display your open position, click on the Trade tab at the bottom left of the platform. You'll see all of your open positions displayed here. By clicking on any of your positions, you'll get the option to close it or modify it. To close your order at any time, click the yellow Close button which appears in the pop-up order screen when you click on your open trade. Technical Analysis offers a series of tools which you can apply in your trading however you like to trade. The basic tools that the technical analyst uses are trend lines, moving averages, support and resistance levels, and Fibonacci ratios. These tools can be combined with price templates, candlestick chart analysis, technical indicators, channels, and more. The Forex technical analysis process is a zoom-in process. Begin by familiarizing yourself with several currency pairs. Conduct a general technical analysis for each pair. Define a trend, and then map the trading opportunities. From here you progress to selecting the specific pair and the specific opportunity which you want to trade before formulating your strategy. Support is a level at which a falling currency pair encounters resistance from the market. This happens because the number of traders who expect the price to stabilize or rise is greater at this level, so the pair is literally supported. Resistance is a level at which a rising currency pair struggles to increase further in value. The number of traders who believe that the pair will not cross this level is greater, so the pair resists further price rises. Support and resistance levels are a matter of human psychology. They exist because the traders in the market believe them to exist and act accordingly, by selling near resistance and buying near support. Economic news and important political events have the power to trigger big movements in the Forex markets. By analyzing it, you can better understand how the markets are likely to move in the future. When examining economic data, you should study the previous results and forecast results, and then compare them with the actual results. Movements in the market happen when there is a difference between market expectations based on the previous and forecast results and the actual result. Interest rates. Each currency has a daily interest rate determined by the nation's central bank. Lower interest rates can cause the value of the national currency to weaken. Higher interest rates can cause the currency to strengthen. Growth indicators like GDP, gross domestic product, inflation indicators like PPI, producer price index, CPI, consumer price index, and construction indices can all have an important impact on the currency markets when the latest news is released. Rises in any of these indicators can be a signal that interest rates are likely to rise. Employment indices. The unemployment rate is an important measure of economic strength. High unemployment rates suggest that a nation's economy is weakening and can cause its currency to also weaken. Congratulations! You have successfully completed this introductory course on Forex trading. In this course, you were introduced to the basics of Forex trading. You should now be ready to start exploring the markets by yourself. Stay tuned for forthcoming advanced lessons on online trading.